All right, everyone, settle in. Today, we're taking a pretty big step in your journey as future business leaders. We're going to move away from some of the abstract math theory you might have seen before and get into the very real, very tangible world of corporate finance and business strategy. We're going to explore an incredibly powerful tool that, I promise you, is going to change the way you look at a balance sheet, a production schedule, and a marketing plan forever. And that tool is integral calculus.
Okay, let's just get right to it, because I know this question is on your minds. I see it every single semester. Professor, I'm here for management, for marketing, for finance. I'm not planning on being a mathematician, so why are we breaking out the calculus? And you know what? That is an entirely fair question. So I want to tackle that skepticism head on, because the answer is really the key to unlocking a much deeper, more accurate, and frankly, a more profitable understanding of the businesses you are all going to run one day. See, the truth is, simple algebra can tell you about a single point in time. Calculus tells you the story of the entire journey. And as leaders, you're responsible for that whole journey.
So to answer that why, we really need to reframe what you think integration is. For just a minute, I want you to forget all the intimidating symbols and the formulas you might have seen. From a business perspective, from the viewpoint of a CEO or a CFO, integration is about one simple thing: the power of accumulation. Think about it. Most of the financial reports you've learned about, like a quarterly earnings report or a daily sales figure, they're just snapshots. They're static pictures of one single moment. But business isn't static, right? It's a continuous, dynamic process. Integration is the tool that lets us move beyond that single snapshot and actually analyze the entire continuous flow of business.
Let's really focus on this core idea. A rate of change in business is just how one thing changes when another thing changes. The classic example is marginal cost. How much does our total cost change when we produce just one more item? Or marginal revenue. How much does our total revenue change when we sell one more item? These are dynamic, constantly shifting measures. Integration is the mathematical process that lets us take that rate of change and find the total accumulated result over a period of time. It's like taking the cost of the very first unit, and the second, and the third, all the way up to the 1,000th, and stitching them all together to see the whole cost journey. Business is dynamic, so we need a tool that's built for that reality.
Now, this analogy is perfect. I want you to really lock this in. Imagine you're driving a car. The speedometer tells you your speed at this exact second. That is a marginal rate. It's useful, tactical info, but it tells you absolutely nothing about the total distance you've traveled. The odometer, on the other hand, that does. It has been accumulating every single moment of your journey to give you the total distance. That's the integral. So as a manager, knowing your marginal cost to produce the 100th unit, that's like glancing at the speedometer. It's important for sure, but knowing your total cost to produce all 1,000 units, that's looking at the odometer. And you absolutely cannot plan a long-term strategy. You can't price a big contract. You can't build a yearly budget without that odometer.
Excellent. So we've got our core concept down. Integration is the odometer for business. Now let's actually apply this odometer principle to the two most fundamental pillars of any company's P&L statement: cost and revenue. This is where the theory really becomes practice, and you're going to start to see the immense power of this tool in making real financial decisions.
Okay, imagine this scenario. You're the chief operating officer of a manufacturing firm. Your operations team, after a ton of analysis on the production line, hands you a mathematical function. Let's call it C prime of X. This function describes the marginal cost, the precise cost of producing the next single unit. Now, why is it a function and not just one number? Well, because of real-world stuff, right? For the first few hundred units, you might have economies of scale. Your cost per unit actually goes down as you get more efficient. But to produce unit number 1,000, maybe you have to pay workers overtime or run the machinery harder, which causes more wear and tear. So the cost of the 10th unit is totally different from the cost of the 1,000th unit. The rate of change isn't constant.
So here is our business problem, laid out nice and clear. We are given the marginal cost function. That's our rate of change, our speedometer. But the board of directors, they don't really care about the cost of the 501st widget. They want to know the total cost to produce an entire batch of, say, 5,000 widgets for a huge client. That's the strategic number. That is our goal. So mathematically, what we're trying to find is the definite integral of our marginal cost function, C prime of X, from 0 to 5,000. Now, that notation might look a little scary, but all it really means is add up the marginal cost for every single unit, from the very first one all the way up to the 5,000th.
And this slide right here shows the solution beautifully. We apply the process of integration. That integral symbol you see, the integral, it's really just a stretched out letter S, and it stands for sum. Conceptually, what we're doing is we're adding up or summing the cost of the very first unit, plus the cost of the second, plus the cost of the third, and on and on and on for every single one of those 5,000 units. We are accumulating all of those tiny individual marginal costs to find our grand total. We're finding the total area under that marginal cost curve.
And after we do the integration, we get a number. But I want you to look at this number not as the answer to some math problem, but as a cornerstone of your business strategy. This total cost figure, it dictates your entire pricing model. Can you price your product competitively and still hit your profit margin? It informs your budget for the quarter. Do you have the cash flow to support this production run? It tells you if this big client's order is even profitable to begin with. This number, which we got from integration, isn't just accounting. It is critical, forward-looking business intelligence.
Okay, fantastic. Now that we have a solid grip on how to accumulate costs from a marginal rate, let's flip over to the other side of the ledger. We can apply the exact same mathematical logic, the same principle of accumulation, to calculate total revenue. The mechanics are identical, but the business application is every bit as important.
So in this case, our given is a marginal revenue function, r prime of x. This function tells us how much extra revenue we get for each additional unit we sell. Now this is often tied to the product's demand curve. As you remember from your economics classes, to sell more units, you often have to lower the price. This means the revenue you get from selling the 10,000th unit will probably be less than the revenue from selling the 100th unit. Again, the rate is not constant. So the CEO comes to you and asks, what is the total revenue we generated from selling the first 10,000 units this quarter? Once again, we have the rate, and we need the accumulated total. We're going to integrate r prime of x from 0 to 10,000.
Now, this is where it all culminates. The most powerful analysis happens when we bring both sides of the equation together. Because in business, it's not just about what you spend or what you earn. It's about the difference between the two. It's about what you actually keep. We are going to use integration to calculate the ultimate metric of a company's success, total profit.
So the crucial point here is that profit itself has a rate of change. We call this marginal profit. And the marginal profit for any given unit, let's call it P prime of x, is simply the marginal revenue for that unit, R prime of x, minus the marginal cost for that unit, C prime of x. Since both revenue and cost are changing functions, well, the marginal profit is also a dynamic fluctuating function. To find our total profit for the whole year, we can't just look at one day. We need to integrate our marginal profit function, that P prime of x, over the entire period, from day 1 all the way to day 365.
Okay, let's pause right here. The question on this slide represents maybe the single most common and most dangerous analytical mistake I see students and even junior executives make. It's a shortcut, and it seems so seductively logical on the surface, doesn't it? Look, on December 31st, our marginal profit was positive, so for the year, we just multiply that by 365, right? This kind of thinking is a trap. It is a fundamentally flawed assumption that can lead to some disastrously wrong business projections and, frankly, some terrible strategic decisions.
Let's break down exactly why that shortcut fails so badly. It assumes a static world. It assumes the profit you made on December 31st is the same as the profit you made back on January 15th or on July 4th. But is that true? Of course not. Your material costs fluctuate with the commodity markets. You're on a massive marketing campaign in the second quarter that spikes your demand, but also increases your costs. There are seasonal sales cycles. Your main competitor launches a new product in September, forcing you to lower your prices. Assuming that a single snapshot from one day represents the entire year's journey, it's like assuming the speed you were going at one moment on the highway was your speed for the whole trip. It will give you a dangerously inaccurate picture of your company's financial health.
But when we do the work, when we properly integrate the marginal profit function over the entire year, we get the true story. We get the actual accumulated result that accounts for all the ups and downs, all the seasonal cycles, all the market shocks. This number, the integral, it might be wildly different from the number you'd get from that tempting shortcut, but this is the only number that matters. It's the number for your year-end reports, for strategic planning, for your investors. It is the ground truth of your company's performance.
So let's bring this all together. The big takeaway is this. We've done a lot more than just solve a few math problems today. We have introduced a whole new way of thinking about business data. This isn't just about calculation, it's about developing a new strategic framework, a new mindset for leadership.
Let's actually give it a name. Let's call it the integral mindset. It's a simple three-step strategic process. First, identify the rate. In any business problem you're facing, from operations to marketing, learn to spot the key rate of change, the speedometer. It could be marginal cost, daily new users, whatever. Second, integrate for the total.
Use the tool of integration to find the big picture, the odometer. Find that total accumulated value over a meaningful period, whether it's a quarter or a full year. And third, and this is the most important part, decide from data. Use that accurate, accumulated total to make smarter, more defensible, and ultimately more profitable strategic decisions.
And I want to leave you with this final thought. Your competitors, they're looking at snapshots. They're looking at yesterday's sales figures at today's stock price. They are managing by looking at the speedometer. The integral mindset gives you a profound strategic advantage. It allows you to see the entire journey, to understand the true accumulated picture. And the ability to see the whole year, not just today, is what separates a good manager from a great visionary leader. And that is why you, as future business leaders, must care about calculus.